Okay, everybody, we are live. I am so excited to be here with you. This is Nick here at the Super Trader. We're going to go ahead and get started with this. This is our final trade of the year for 2015 with this monthly income approach. We've had quite the year, and I just want to take just a few moments here to review our previous trade and our year so far. And we will hop right in and get to structuring our new position. So let's go ahead and head over to monthly income dashboard and take a look at our closed positions log. We've had certainly not a quiet year. It has been quite volatile. Let me just go ahead and pull up our charts here. And let's head over to the S&P. So yesterday we had the first rate hike from near 0% interest rates, and the market has been just trying to find some balance here. Yesterday it was fairly two-sided. We had a lot of back and forth on both sides of the market, but today we are balancing right back down to the downside. So we'll see what happens. I do expect more volatility going forward. I'm going to go ahead and let's hide these drawings right here and take a look at our year. We had quite the late summer, early fall, I guess it would be the fall time, and the whole sell in May and go away ended up working out this year. This year it was very, very quiet during the summertime, and when everybody came back, they decided to sell it off, and we experienced that big pullback in the market, and we were able to get through it just fine. And we actually eked out a little $500 profit after that adjustment. But in any case, guys, all in all, we're on track. It's not our best year for this system, but it certainly has been a great year compared to the market. Right now, year to date, what are we at? The market, let's see here. 2058.20, we're trading at 251. Yeah, we're still down on the year, folks. We're down about 7 points on the year on the S&P. So I would say, what we've done is a lot better than a sharp stick in the eye compared to what has transpired in the overall broad market. So let's go ahead and quickly take a look at our previous month's position. Our previous position, we ended up, we had, let's go pull it up right here. There we go. Okay. So, this particular position, we ended up selling the 2120 short calls, and we sold the 1860 short puts. That's represented right here on our charts. We got into that position, so that solid red line up top, that was our short call strike. We wanted the market to ultimately stay below that level come options expiration, and this green line down here below, that was our short put strike price. The dashed green line, that was about where we would have a 70% probability when we initially structured the trade on our short put. And same thing up here for our short call. That dashed red line was about where we would have a 70% probability. That ended up not being the case. Let me just pull up our trade here. We ended up structuring this trade on the 11th of December. So let's go ahead and pull it up here. So the 11th of December was right here. I'm sorry, it expired on the 11th of December. We structured this position on November 16th. Sorry about that, folks. November 16th. So it was right there. And we had quite the run-up. On this day, we actually stayed below a 70% probability, or above a 70% probability, rather, even though it was up above our original expected barrier where it would have been. Again, folks, for those of you that it's first time here, we adjust our position if our short strikes hit a 70% probability. All of this is discussed in the training, the monthly income training. But when we hit that dashed red line, we actually still had above an 80% probability, and it remained below or above a 70% until this day right here on the 1st. We ended up closing that day with a 68% probability. So we were going to adjust the next day, and we ended up having a nice big sell-off, and it just continued to do so. We had one little pop there, but it was short-lived and continued to fade nice and strong into expiration, which was last Friday. And normally we would structure this new position on the following Monday, but because of the interest rates, the FOMC decision, we just wanted to make sure that the market got that out of its blood before we got in. And I'm glad that we did, because look at this big run-up that we had into that. We would have structured our trade way down here, and our short put strike price, or our short call strike price, would probably be challenged already. It's tough to say, but in any case, I really like where we're at in the market to structure our new position today. So let's go ahead and get into that. So by way of just some parameters, we structure our position with a 90% probability with our short calls and our short puts. So let's head over here to the trade tab. Now we're going to go out to the second Friday in January options. Okay, so that's 22 days away. The reason why we do that is so that we can allow them to go fully to expiration and expire worthless. If you do the regular monthly options, the last trading day for the regular monthly options is Thursday, the third Thursday of the month. However, what determines whether or not your position expires worthless or not is based on what the market opens up at on Friday morning. But you can't trade it Friday morning, and so you could be really stuck in a bind if anything really severe happened. You've got a lot of risk out there. So we like to allow these to expire worthless, because even if we're buying it back for, say, 5 cents on the regular monthlies, you tack on an extra about 3 cents in commissions, plus buying it back for 5 cents prior to the regular monthly position expiring, you're giving back 8 cents of your premium. Times that times 12 months out of the year. That's 96 cents, folks. Our average premium this year so far has been 76 cents. Okay, so if we're giving back 96 cents in premium throughout the year between transactional costs and buying to close the position, that's more than your average full month of income. And so that's why we like to allow these positions to expire worthless. It saves us a whole lot in the end, and we've just found that it makes a lot of sense to go ahead and go with those weekly options. We've chosen the second Friday of the month options, and there's still plenty of month left, so we're going to stick with those instead of going out to the fourth Friday. We'll go ahead and go with the second Friday of January, and that will be our final position for the year. So let's get into it. So what we're looking at here, folks, is we're looking at this tab here where it says probability OTM. Right here, that stands for probability of being out of the money. All right. And what we're looking for are the options that have a 90% probability, or if you don't trade at Thinkorswim and you don't have that that probability column there wherever you're trading it, what we're looking for are the options that have around a 10-cent delta. Okay, so a delta of 10 cents is roughly the equivalent of a 90% probability of expiring out of the money. There's a slight difference in the in how they compute the statistical probability with this probability tab, but you know, you're fairly safe to go with the delta if you don't have that tab. That's okay. And we discuss all of that in the training, so I would encourage you to go and watch that. So I'm going to go ahead and right-click on that 1910 strike. I'm going to go up to Sell, and I'm going to go over to Iron Condor. That's going to go ahead and set us up in an Iron Condor here. Let's see here. Sell, Iron Condor. All right, so that's going to structure Iron Condor. It's going to put a quantity of 10 contracts there. Disregard that. I'm going to set it 0 right now. While we structure this. Okay, so it's structured. We just put together the put side of the trade. So we're selling the 1910 short put. We're selling the short put. Selling and short, that's the same term. So I could really just say we are shorting the put. But we're selling the put at the 1910 strike, right there, -1. And we were buying the 1905. So we are getting to a $5 wide spread. For those with significantly larger accounts in excess of 500,000 to $1 million, we would typically consider going to a little bit of a wider spread, like $10 wide spread, and certainly when you get up into seven figures, we'd be looking at a $15 wide or greater. But that's in the training, and you can get all that there. So we got the put side set up. Let's go ahead and scroll down our options chain here. And we're going to do the same thing on the call side. We're going to find the options with a 90% probability over there, or around a 10-cent delta. And those are the options that we're going to sell over there. So I'm going to look at the 2140s right now and see they're slightly above a 90% probability, which is great. I just want to see what I can get for those. So we've got a mid price here going on of about 75 cents to 80 cents. But if I could get 75 cents out of that, I would be quite pleased. I just want to see the difference that it makes if I sell the 2135. We may need to go with the 2135s to get a fill on this. I'm going to go for 75 cents here on this one. Let me go ahead and take a little snapshot of this. We're going to put this in our notes, and we're going to walk through everything. Okay, and then I'm going to throw this over into what's called our risk profile. And we're going to analyze our risk in this position. So I'm going to just take that screenshot that we've got there and put that over here in our notes. We'll make these notes available to you, obviously, right after. Okay. Got that. And now what we're looking for, folks, is we are looking at about where our options will hit, about where our short strikes, or the options that we're selling, will hit a 70% probability. So let's go ahead and go over here to our chart and reposition this solid red line at where our new short call strike price would be, which is the 2135 strike. So we're going to go ahead and put that there. And that's great. We're getting above the all-time highs today, so far here to date. And we are going to go ahead and restructure our solid green line, which is where our short put strike will be, and that is down at the 1910 price level. Okay, so now that we've got that, let's go ahead and go figure out where these dashed lines should be. That's where we will set an alert to be notified. If it hits those levels, we'll look to adjust possibly. But otherwise, we just sit back and relax. So let's go back to our trade tab. And again, we've got a new tool. I'm working on getting this out there, guys. I apologize. We've been rolling out a lot of new things. And we've got an awesome, awesome tool donated to us by one of our own in the community, Buck. He's amazing. He's created a tool that really makes it easy to do all of the math in terms of figuring out the 70% probability. And I'm so sorry I don't have that out to you yet. I promise you I'll get that to you within the next week. So stay tuned for that. But the long way of doing it is we find our short strike price. So in this case, on the call side, we sold the 2135 calls. And what we're going to do is we're going to take the difference between that strike price, 2135, and the options that are currently trading around a 70% probability or a 30-cent delta. Okay, so the difference between 2135 and the option that is currently trading at around a 70% probability, which is the 2095 strike, the difference between those two is 40 points. So if the market were to rally 40 points today, that would put our 2135 strike, which is the option that we sold, at around a 70% probability, and that's about when we'd look to adjust. Now, the longer the market takes to go up 40 points, the higher probability we're still going to have. So this computation does not calculate the effect of theta decay. The longer it takes to go higher, move that 40 points higher, the higher probability we're still going to have. And so even if it were to move 40 points, the first thing that we do is we check our probabilities. So the alert is simply just that. It's an alert to come and check what our probability is. If it's at around 70%, then we'll look to adjust. If it's higher, we'll sit on our hands, continue to monitor. Okay, so let's go ahead, and what we're going to do is we're going to tack 40 points, that difference between our short call strike and the option that it currently has a 70% probability. That's the 40-point difference. We're going to tack that 40 points onto where the market is currently trading right now at 2055. So right now, if the market were to go up to 2095, which is 40 points above where it's trading, that's about where we would have a 70% probability on our short call strike. So I'm going to go ahead and move our dashed red line up to 2095. Okay. All right. We're going to go and figure out what it is on our short put side. Again, we are selling the 1910 puts. Okay. We're selling the 1910 puts. We're going to take the difference between that strike price, which currently has a 90% probability, and the options that are currently trading at around a 70% probability, which is that 2005 strike. Okay, so the difference between our short put, 1910, and the option that is currently trading at a 70% probability, which is the 2005 strike price, is 95 points. If the market were to drop 95 points, it would get closer to our short put, giving a lower probability that that option expires out of the money. So if it were to drop 95 points, that would put our short put strike price roughly where that 2005 strike is, giving us around a 70% probability. Now, that is only correct if this were to happen very quickly. The longer it takes to happen, the higher probability we're still going to have. So again, if the market drops 95 points from where we're currently trading, oh, give me 1 second. I've got a little scratch in my throat. If the market drops 95 points from where we're currently trading at 2056, we moved up, I think, 50 cents. We're just going to use 2055. So if it goes down to 1960, that's where we're going to get an alert that says, hey guys, go check us out. We may have a 70% probability. If we do, we will look to adjust. If we still have greater than 90% probability, or 70% probability rather, we will sit on our hands. We won't do anything. We'll just continue to monitor and wait until we have around a 70% probability. So that is our new level. This particular position will expire on the second Friday of January, which is January the 8th. Man, we've got a lot of holidays going through this, so that's a nice time decay where the market's going to be closed, which is sweet. Okay, so we've got 22 days remaining. I'm going to go ahead and take a snapshot of this chart. That vertical blue line represents where our position will expire. Day that our position closes. Let's go ahead and put that chart in our notes, and let's go fill out our trade log here. Okay. All right, so let's go ahead and fill out our trade log. This particular position does expire on, again, January the 8th, 2016. It is an iron condor, the strategy. We are selling the 2135 calls. We're buying the 2140s. We're looking to, and that ticket is right there, that pink that pink order right there. That's the trade ticket. And this tool that Buck built will also create a beautiful order ticket for you automatically. It's really amazing. So I'm super excited to get it out to you. And again, I'm so sorry that I haven't running 1,000 miles an hour. My daughter, actually, we had to take her to the ER last night for suspected appendicitis. We were at the ER until about 3 in the morning. So running on fumes. But all right, we're looking to sell the 1910 put and buying the 1905 put. We're looking for around 75 cents a premium. As a minimum, we would expect we wouldn't get into this position for anything less than around 65 cents, just as a minimum. So our risk in this position is that it's the distance between the option that we're selling and the option that we're buying. So there's a 5-point differential on both sides of this trade. Okay. However, our risk is only on one side of the position because the market could only be above that red line or below that green line at one point. It can't be both above that red line and below the green one at the same time. Again, if you're not quite sure why our risk is what it is, go and watch the trainings that we've got out in the monthly income training, and that will walk you through everything. So our risk is $5, the distance between the short strike and the long strike, minus the credit of 75 cents, giving us a $4.25 risk in this case. Okay, and that would give us a 17.6% return in 22 days. And the way that I figured that out, folks, again, Bucks Tool will do all this for you, is you take 75 cents a reward, divide that by a risk of $4.25. It's going to spit out a number, 0.176. Times that number by 100. If you can't see it, it's 17.64%. Okay, so that's going to be a 17.6% return. We only have 22 days remaining until this position expires. By way of our position management plan, let's go ahead and take a look at that in our analytics, in our risk profile over here. So again, we're going to be adjusting this position if it goes up to around 2095 or down to around 1960. And what we want to do is we want to make sure that our loss is no more than double what our premium is. Okay, so we want to make sure that it stays below 2 times our reward. So in the middle here, I've got my where the market is currently trading in this price slice. Okay. Mike says the 2070 seems wrong. Oh, in the price slices, is that what you're referencing? It is wrong. I haven't set that up yet. Yep, that is wrong. Okay, so what we're going to do is we're going to go ahead and plug in the price slice directly above where the market is currently trading. We're going to plug in what our adjustment level would be for our short call, which would be the 2095 level. So let's go ahead and put that in right there. There we go. And I'm on the top one, I'm going to put in my strike price of 21.35. I'm doing this to show you that your loss is a lot greater than what we can tolerate. It's way great. It's a lot more than 2 times our expected reward if we're to allow this position to go all the way up to the 21.35 strike. And mathematically, you just won't ever make any money. And I'll show you that here in a minute. At the end of this, we can do that. But okay, so we got that side set up. We'll walk through it here in just a minute. Let's go ahead and the strike or the price slice directly below the current market price, which is right there in the middle. That one is going to be our 70% probability level for our short put, and that level is the 1960 price level. Let's go ahead and put that in. And then let's go ahead and the very bottom one, let's go ahead and put in our short put strike price, 1910. Okay. I'm going to take a snapshot of all this, and we're going to plug this into our notes. Let me just make a couple of, let me just highlight a couple of things here, folks, so it makes it really easy for your eye to see. what those 70% probability levels are. There we go. Alrighty, let's go ahead and plug this into our note and discuss it. While we're doing this, I'm actually going to go ahead okay. Okay, so what do we have here? In terms of our position management plan, our PMP, we've got both a profit management and a loss management portion. For this particular position, our profit management plan is normally to capture the entire thing. We allow these options to expire worthless and capture the full premium that we're getting paid. For the loss management plan, we would look to limit our losses to no more than, in this case, we want to look to limit those to no more than around 90 cents on the 2095, which is about where our short call strike price will hit a 70% probability. We're going to have around an 83-cent loss. Again, right here it says $83, but you've got to divide that by 100 shares because we've got one contract here in the math that we ran. So $83 loss is the equivalent of 83 cents for one contract. So we can bump that up just a bit here, and I would say that maybe we'll give it a leniency of about 90 cents. So we want to make sure that our overall, oh, awesome, Mike, or Brett, sweet. So it's filling 80 cents. That's good to know. That's awesome. My order's still sitting out there. So we're going to look to limit our losses to no more than 90 cents. We observe through the risk profile on TOS, the Think or Swim platform, that we would have around a 83-cent loss right there if the short strike price went to if the short call strike price went to a 70% probability. So let's go ahead and change that to 83 cents. Which would be around that 2095 price level. So I've got that side changed. So perfect. We would have around an 83-cent loss, which is below the expected limit loss of 90 cents, right? And also we would have around it looks like a 60-cent loss per contract if the short put strike went to a 70% probability, which would be around that 1910 price level. Okay, perfect. Somebody double check me here. I'm just double checking myself. So we would look to limit our losses to no more than 90 cents. We observe the risk profile on TOS that we would have around an 83-cent loss at that 2095. Great, got it. Also that short put strike, we would have around a 60-cent loss. Probably could round that up to 61 cents, right? Not if you're filling at 80 cents. It's going to look better than this. So, folks, on the outer sides of this risk profile down here, these price slices, I've got our short strike prices. The 2035 is our short call, and then 1910 is our short put. Take a look at the loss would be down there. Okay. Obviously the short call loss would be greater than 2 times our expected reward. That's worst case scenario. We want to make sure that under no circumstances it becomes more than 2 times our expected reward, and make sure to keep that under. And so I just have that for reference, and really we want to keep it as low as we possibly can. But again, there's a lot of room for leniency, folks. I mean, we're well under 2 times our expected reward with those potential losses there. So we'll be able to adjust just fine if need be, and be able to get ourselves out of that loss by executing the adjustments that we do here. Okay, so by way of just a reminder, we never risk more than 20% of our net liquidity, and if we're using that much, we are keeping 80% of our portfolio sitting in cash to be used for adjustments. Okay, so I just want to make sure that that is very, very clear. We've used 20% of our portfolio for this model portfolio all year long. Okay, but if you are going to be using that, you've got to have cash set aside to make adjustments. That's a mistake you don't want to miss. If a 2008 were to happen where we go down over 30% in just 1 month, we want to make sure that we've got enough cash on hand to execute our adjustments and to be able to manage these trades properly to avoid major losses. Okay, so in this case, let's say I had a $100,000 account. Okay, and I can only risk 20% of that. That's $20,000. Okay, so if I have risk capital of $20,000 I can commit to this position, in this trade, I've got $4.25 of risk per contract. Okay, one contract is equal to 100 shares, so 425 times 100 is 425. So I'm going to take my risk capital of 20,000 and divide it by the risk per contract, which is $425 total per one contract. So I could take on a total of 47 contracts if that's the case. Okay, so just want to make sure that that is something that's very, very clear. Our model portfolio, we're just over 133, so we could use 26,006 of risk capital divided by 425. So we're looking at 62 contracts. Okay, folks. So any questions at all on anything that we have done or discussed today? Any questions at all? Does this make sense? It's been a great year. Really excited. So this will give us about another 4.6% on the year if we don't need to adjust it. So expecting to close out the year with about a 37% return on the year compared to the market. It's phenomenal. So any questions, guys, on anything that we've talked about today? Okay. Well, this will be recorded. This is recorded. It will take just a bit to get it up there. I will get the notes posted right away. And you'll be able to access those. I'll also send you an email with that. It will be in the open positions log for the monthly income approach. Okay. Yes, Carol, go ahead. What's well, if we need to, we need to. But yeah, I hear you, Hal. It'd be nice to close the year out, not having to adjust it. So Carol, Carol says, why is it kind of lopsided? Is that your question there, Carol? Yeah, we had a nail biter month last month, didn't we, Hal? Oh yeah, Carol, so why is it lopsided? It's such a good question. It's because probabilities aren't linear. We've got all these different price levels out here, right? And so it's going to be lopsided because a lot more of the price action is coming from below. So the numbers that they're using to compute that probability are based on the trailing period. And as you can see, the majority of the days are trading below the level that we're trading right now. And so, there's a lot more movement that occurred down here. We explain this in the classes in depth in a lot simpler. I use an example of your neighborhood income levels and computing what the expected incomes are. But yeah, it's lopsided because all of our price action previous to today is a lot lower than, or it's mostly lower to equal to where it's trading at right now, and so we have a greater probability of testing down here than we do up there. Now, if we were trading way down here and all of our previous days here on this year were trading above this price level, where we're currently trading, then you would see it lopsided to the other way. Okay, it's never going to be, Carol, ever. The statistics aren't linear. Now, if you had a let's see here, I'm trying to find a little whiteboard. I'm not finding one. Let's see if I can just draw on this. So try to ignore the in the middle. So if you had a set of data, let's say you had +5, +4, +3, +2, +1, 0, -1, -2, -3, -4, and -5. That's all the data is equivalent, and so if you had that type of set of data, then you would have just as much of a probability of going up to 5 as you would down at -5, right? If it this is really a terrible example. We give a really good one in the classes, but let's say again this is a stock, and let's say it's gone up to +1 and back down to -1 and back up to +2 and down to -2 and up to +3 and down to -3 and up +4 and down to -4 and up to +5 and down to -5. It has spent just as much time on the positive number as it has on the negative number. Okay, and so for that reason, the probability that we're to go up to a positive number really is about the exact same probability that it goes down to that negative number. Now, let's say it goes up to +1 and then up to +2 and then back down to +1 and up to +2, up to +3, up to +4, up to +5, down to +4, up to +5, down to +4, up to +5, down to +4, down to +3, down to +2. You know, you're spending a whole lot more time way up here, and so in any case, all your data is coming from up here. You're going to have a lot higher probability of going up higher than you are going down lower. And so if you take a look at our chart, where is all the data? Is it above or below where we're currently trading at, Carol? A lot of it is significantly below down here, majorly below, and you know others are kind of equivalent. Okay. And so it's actually not equal. If you look at, we have a lot more. It's very balanced. If I draw a line right where we're trading at right now, okay, the highs of the year are right here. So let me just we'll put this at purple and I'll make it really big. Okay. Okay, so that's where we're trading at right now. The high of the year, the highs of the year are up to here. Again, I'll make that line purple so that we don't confuse it with other lines. Okay, so that's the high of the year. The lows of the year are down here. So we've tested significantly lower this year, the range, than what we have higher. Okay, so it's going to have, they're pricing out that the 90% probability is going to be further from the money, because if it does drop, it's probably going to drop a lot greater than what it could go up, because we're kind of trading in that small top of the range here. So in any case, the statistical probability, and again, I give you a really good example in the classes. The probability actually that we're looking at is actually calculated over the past 30 days. Whatever the time period you're trading, so 22 days is what we have remaining, that's where that probability is coming from. But in the training, we talk about how we came up with all those numbers, and it was based on over a 10-year study down to the minute charts. We actually studied the minute versions of these charts and figured out the best proportion of where we would most likely be right the most amount of times for the reward that we were looking at, and also we computed the max amount of loss that we can tolerate and still make money long term. So get into that training. That training has everything you would need to understand all of this. So we actually have a full class on statistics and probabilities. So I think it's week 2 in the monthly income training. So that would be a really great place to go to understand better, how all these statistics and probabilities work and what all of it means. So week 2 would be a great place to go. Okay, folks. Any other questions? Yeah, it was Hal. Nail biter for sure. Yeah, it did. It went away. That was nice to have it close well away from where it was. All right, guys. Well, let me get the stuff posted up. And again, we're going to be looking at a lot more positions now going forward, now that everything's kind of put together here. We will be getting into several explosive profits positions. I'm eyeing a couple of them. They're not quite where they need to be. Looking at MMM as one of them, and so we've got a couple of others out there. But as of right now, we've got a training later on this evening at I believe 5 p.m. Eastern time. Let me check out. Let's see here. We've got a capital growth trading, optimizing your entry will occur at 5 p.m. Eastern time. We've got 3 trainings tomorrow, a big week next week going into Christmas, and just getting all these trainings out. So capital growth trading, part A of optimizing your entry is going to be this evening at 5 p.m. Eastern time. So look forward to seeing everybody there. And give me about 30 minutes, folks. I'll get all this stuff posted up. I'll take a screenshot of these notes and go ahead and post them in the trade chat here for you. Let's just go ahead and do that, especially this trade log portion. Okay, and then we'll go ahead and post this right here in the notes. Or, I'm sorry, in the chat. So, let's see, where's it at? Okay. You guys should see it now. It should be popping up right in your the chat log there. You can click on that and view a larger version of it. So, all right, guys, I'm going to wrap up, get this all posted up in our open positions log, and you can rewatch it if you need to. If you have any questions, I would say head over to the Trader Engage forums. Okay, that's the best place for you to go because everybody else has probably the same questions. You go over the Trader Engage forums, click on whatever your your topic is, your question. Head over if you have a question on the monthly income trade that we just did. Go over to the monthly income forum and post a question. That's probably the best place for you to get answers to those, and that'll help out everybody else as well, as most people probably are asking the same things that you are. So, hope this has been helpful, guys. Hope you have a great rest of the day, and hope to see all of you in the upcoming classes. And here's to a final great month in the monthly income trade. Everybody, until next time, trade super.